Hello and welcome to the CNBC Africa special. I'm Chris Bishop. Now, it's one of the biggest precious metals producers in the world, buffeting through the rough, tough times for mining in Africa. Like many in the business, it is digging deep to survive. This is the story of Sibanye-Stillwater. It mirrors all the problems and pitfalls of South Africa's shrinking mining industry. It is battling against debt, rising costs, unfavourable regulation, and it is also plagued by safety problems. All this in an industry that in 1994 contributed 14% to GDP. Now that's halved to a mere 7%. The current gold wage talks in South Africa are a sign of these diminishing times. 3 years ago, 93,000 gold workers negotiated a new pay deal. This year, it's a mere 80,000. Let's get back to that story about Sibanye-Stillwater. In this shrinking industry, Sibanye-Stillwater has bucked the trend to grow at breakneck speed since it was unbundled from goldfields back in 2013. From these offices in Johannesburg, it runs gold and platinum mines that employ 65,000 workers in South Africa and 1,400 more at its Stillwater operation in Montana in the United States.
Started as a junior engineer at Lebanon for Goldfields. I got more exposure in the engineering side. While I was developing, I did a BComt, a Bachelor of Accounting Science, which has put me in a good place for where I am today. But then I moved more into a consulting role and then did my manager's ticket and ended up more on the operating side of the business, and in the last 20 years being the CEO of listed companies.
I don't think it's an easy business for anybody to operate in, and there have been many casualties over the years. I think Neal Froneman is well regarded as someone that understands mining. He's got a very strong mining background. And he is able to make a commitment and stay with it.
The man at the helm is Neal Froneman, a mining engineer by trade with nearly 40 years in the business. He worked his way up from working deep underground.
I spent a lot of time underground. When I did my manager's ticket, I had to go back and do a blasting certificate, and I've had my fair share underground.
In anybody's book, these are difficult times for mining, especially for a company that bought up a string of marginal mines. That's industry speak for battling mines. This was the announcement of one of these acquisitions, Aquarius Platinum, at a plush Johannesburg hotel back in 2015. The price tag for the deal, $294 million. A fair splash of cash in depressed times for the platinum industry, paid at a healthy 19.5 cents per share, financed with the help of $300 million in credit from HSBC. It joined Sibanye's string of marginal mines that date back to the 1950s and burn the cash. Gold operations, Driefontein, Beatrix and Kloof, produce around 1.2 million ounces of the yellow metal a year. Rustenburg Platinum and Aquarius Platinum contribute to more than 1 million ounces of PGMs. Rising costs have squeezed margins at all of these mines.
How difficult is it to operate in this very difficult mining environment? You've got weak commodity prices, you've got rising costs. How difficult is it?
It's very difficult. South Africa has its own unique characteristics, which I dare say probably make it more difficult than just about anywhere else in the world. We have a vision of creating superior value for all stakeholders, and that's quite a modern concept, and it's absolutely necessary in South Africa, where we have such big differences in earnings and so much poverty that we have to actually look after all stakeholders to run a business smoothly and efficiently.
And how difficult is it to deal with costs? I mean, everybody's cost cutting here. Surely that's going to be something that you're going to have to look at Sibanye.
Oh, absolutely. Look, we are price takers for just about everything we produce. So the only real, let's say, part of the income statement that we can control are costs, and 50% of our costs are related to labor. So we have to be productive, we have to be efficient, and of course many of the other costs are out of our control as well, such as electricity. We've got rampant electricity prices. So a lot of our focus is on cost reduction, and the one way to do that is to grow the business, to make your unit costs lower by reducing your overhead. And consolidation and survival in these tough conditions is a primary way of achieving what I've just described.
And as you know, the wage negotiations are going on for gold at the moment. It's likely that you'll face another wage hike for the next few years. How likely could that lead into job losses at companies like Sibanye?
It's our responsibility to try and ensure that organised labour and our other stakeholders understand the consequences of just demanding increases.
The calamity that has haunted Sibanye-Stillwater in 2018 has been the accidents that have caused the deaths of 21 workers, around half of the country's fatalities in the mines for the year, and has caused an outcry.
It's very traumatic for us, having lost 21 of our family members. Safety is our number one priority, it's our number two priority, it's our number three priority, and we will never ever put and never have put production ahead of safety. It's been very difficult for us because we've come off one of the best performers from a safety perspective over the last 4 or 5 years. In fact, in 2017, we were the best performing deep level gold mining company from a fatality rate, from a serious injury frequency rate. So it's unprecedented to now have a spate of accidents, especially 2, which resulted in 12 fatalities. Now, it's not acceptable to continue as though everything will come right. So we've taken a lot of initiative to try and address the safety performance.
It's been very difficult for you as a mining person. I remember a year and a half ago at the mining endeavour in Cape Town, you were talking about trying to end blasting underground for safety reasons, and a year and a half this happens.
Yes, and where we can mechanise, we do mechanise. In deep level gold mining, there's not a lot of opportunity to mechanise because that sort of equipment just doesn't exist yet. We are sponsoring initiatives such as Digimine through the University of Witwatersrand to develop technology that is going to create a safer working environment. The Minerals Council has got initiatives on developing equipment. But certainly, if we can remove the man from the risk area, we can definitely improve on safety. So in the longer run, I'm confident that we can deal with the technical issues around safety and exposure. But most of the accidents that have occurred due to either a bad attitude or an improper behavior. So we're dealing with human aspects here as well.
The government and will certainly expect them to try and mitigate those risks. There have got to be procedures in place that prevent people from taking those risks. And whether it's through training and education, or maybe stricter oversight, or maybe a combination of those things. But it's difficult, as a company, to lay the blame on workers if something goes wrong.
On the financial front, Sibanye-Stillwater's biggest headache is debt. The company carries $1.8 billion in debt, most of which is in a fixed-rate bond in the United States. The plan is to get the debt down to under $1 billion.
To reduce debt or to reduce leverage clearly will take time if we rely on EBITDA from our own business, and that is one of the deleveraging mechanisms. But more importantly, we've identified 2 other initiatives. The one is putting in a stream, which is not considered debt. It is still a liability because it's almost like a prepay on the commodities you produce. We're looking at doing about a $500 million stream, which I hope we can announce in the not too distant future. That will reduce our net debt to EBITDA from about 2.5 down to about 1.9 times. And then we're looking at some inventory pipeline financing, which is really about debtor management, if you could call it that, reducing working capital, which could probably infuse another $100 million into our debt position.
Lots of the mining companies, especially the big diversifieds, Bulletin, Anglo, Rio, have all reduced debt levels. And of course, with the concern now coming out of China, you saw GDP came in at 6.7, it's marginally a miss. But with the trade war heating up, you could find that, maybe economic activity, certainly on the manufacturing side, starts to slow down, and that would hurt miners, or commodity prices rather, one would think. So maybe not the best time to have a lot of debt on balance sheet.
If the price of platinum and palladium go up, they can bring that debt down quickly, because they've got heavy marginal mines in South Africa, particularly the Lonmin now. So Lonmin probably needs $1,200 an ounce to break even. But after that, should it go higher than that, they make an enormous amount of positive cash flow.
It all means Sibanye-Stillwater's share price has plunged more than 75% in just over a year. One matter that has crossed Neal Froneman's desk is a class action in the United States questioning the trade in shares during the fall.
I think it's very opportunistic. We know the US environment from a litigation point of view, and certainly our lawyers have looked at it. They don't believe there's a case, and we will defend the company very rigorously. So no, there's some way to go. And as I say, I think the drop in the share price is related to the risk of debt and leverage and the environment we find ourselves in. I don't believe it's specifically related to safety, which is what they've based their claim on, so we'll address it in the right way.
And I know it's a very complicated case, but in a nutshell, just for the viewers, what are they claiming and what are you saying?
Well, they seem to base their claims on what they read in the press. And what you read in the press is things like we put profits ahead of safety, and we never disclosed that in our 20F filings, which is complete nonsense. It's those type of issues that are being referred to. They are very speculative, and of course they're not true. So we are able to defend ourselves and show that that's not correct.
In the second half, we'll look closer at how the company is, quote, betting the ranch on the rise of the platinum price, a rise that not everyone is sure is actually going to happen soon enough. Do stay tuned. Welcome back to this CNBC Africa special. I'm Chris Bishop. Now, this is the story of African miner Sibanye-Stillwater, a company digging deep for survival in difficult times. It faces uncertainty over regulation and weak platinum prices. Through all of these problems, Neal Froneman, remarkably, is banking on a major recovery in the platinum price. He's betting the ranch, some analysts say, on a plan to withstand losses until the platinum price recovers to $1,200 or $1,300 an ounce, at which time the company will cash in.
Platinum, we bought the South African assets on the understanding, or on our view, that it would be depressed for another few more years. The 3-year structured agreement with Anglo Platinum was based on a view that it would be depressed for at least 3 years, and we think there's probably another 18 months to go. So we understand the role of electric vehicles, we understand the role of hybrids, we understand the role of platinum cells and so on, and all of that is in our model. So we in the medium term, we are certainly more optimistic and more bullish about the platinum price specifically increasing from these levels.
If the prices stay where they are now or fall, I doubt whether they will survive on the money they've got, and they'll have to do rights issue after rights issue after rights issue, because at current platinum and palladium prices, they're negative cash flow.
How likely is it, do you think, watching the market, that the platinum price will go up to $1,200, $1,300 an ounce that they need?
I think it's actually very likely But the problem is it might only be in 10 years' time.
You know, this is why investments are so interesting. You know, you never know what management is going to do in the next 6 months or even the next year. But listen, if the platinum price goes up to $1,500, this would be a screaming investment.
While waiting for a recovery in the platinum price, Sibanye-Stillwater has to grapple with a new version of South Africa's mining charter. It promises to increase black ownership from 26% to 30% within 5 years. The fly in this particular ointment, according to Froman, is the so-called free carry clause. That is, giving 10% of shares to employees and mining communities. He believes the cost of these shares could scupper some mining projects in a world where the cost of capital is already high.
I am worried from the point of view that we're proudly South African. We are committed to the growth of this country. I think poverty alleviation is only going to happen through economic growth. I just think resources to continuously distribute income and increase taxes are just unsustainable. So we have to grow our economy. Mining is the flywheel of the economy. If we don't grow mining, I think other industries are also going to falter. So the current charter, I think there are good aspects to it. The incorporation of recognizing continuing consequences is good for investors because we're not changing the rules looking backward. If that was to happen, we would, as industry or as business, we represent our shareholders, we'd have to take a stand. So I'm hoping that's not going to happen. It doesn't look like it's going to happen. But in terms of growth, there's not enough competitiveness in the new charter to attract foreign direct investment. Free carries, and we understand that communities need to also benefit from it. That's our whole concept of superior value for all stakeholders is absolutely necessary. But free carry, in my mind, is not going to result in that, and that's going to detract from foreign direct investment, and the industry is going to stay in limbo, which is sad.
Speaking about free carry, I mean, in English, what it means is that people will get shares and you'll carry the entire cost as a company. What's that going to mean for projects and new mining investment?
Yeah. So what it actually means is that shareholders carry that cost because they are donating in kind their shares to these parties. What it means is the hurdle rates, which are going to increase. That's already off a high cost of capital in South Africa because of the political risks and the interest rates where we are. So it means very few projects are actually going to be successful or are going to exceed that hurdle rate, which means that a lot of South African resources are not going to be developed, and of course it's going to be less investment.
Well, this new one's certainly better than the old one, and there are still a few issues to sort out, but I think the mining charter is now probably not probably, it is less worrisome than the one of a year ago.
And they're saying that it, particularly this free carry.
Yeah, the free carry is the only real issue that all the mining companies have spoken about. What the free carry is you've got to give away 10% of your company. And I think there'll probably be a compromise on that where you still issue that 10% to the relevant parties, but they give you some return in the form of dividends. So in other words, for the next 5 years, say, you at least as a company don't have to pay dividends on those shares. You'll still give them away, but at least you will get some return on that.
How likely is it that that's going to happen? I know there's another month to go until...
I think it will happen. I mean, I think the new political dispensation doesn't want to cause chaos in the industry, and I think there will be a compromise.
There's a need to be far more competitive in our thinking around these issues. But to be honest, I think a good mining company can go anywhere in the world. We've shown that if you put your mind to it, you can buy good quality assets in the US. I dare say other companies have moved into Australia, South America, into the rest of Africa. So investment money will go where it gets the best return.
Despite these concerns, Sibanye-Stillwater is going to stick to the acquisition trail. Lonmin,
the world's troubled third largest producer of platinum, is next. A price of around £120 million has been agreed, and the Competition Commission approval is expected by the end of the year.
I'm optimistic that we will get a competition ruling in the third quarter, which is what we said when we announced the transaction. There's been a lot of constructive engagement. This is a very difficult acquisition. So we're looking for a competition output probably before September. And then there's just shareholder approvals which would take place in the last quarter. So a final, or let's say a conclusion of the transaction should happen before the year end.
And the deal itself, I mean, I saw the Financial Times today was quoting £120 million for Lonmin. Is that anywhere near the truth?
Well, what we did is we fixed the exchange ratio when Sibanye was at a much higher share price. Our share price has dropped, so it does look like the acquisition cost is quite low. But of course, we know why our share price is down. It's primarily due to the leverage and the risks associated with that, coupled with the very bad safety incidents we've had. We understand that. But certainly the value in our company hasn't changed, and therefore Lonmin shareholders could look forward to significant price increases in our share price once we normalise that situation. So it does look like a low cost acquisition, but it's because of the change in the ratios having been fixed some time back.
So about £120 million is somewhere near.
Correct.
Okay. And it's going to be quite a difficult asset to deal with. What do you plan to do with it?
Well, certainly I think we have a track record of integrating assets, and you know that didn't just start in Sibanye. A lot of my team has been exposed to the growth in Harmony in the 90s and early 2000s. So we've got a lot of internal experience in integrating and reducing costs through consolidation. Clearly, you know, that is a process that requires all stakeholders to be part of it, but we know how to do it. And at Aquarius, for instance, in Rustenburg, we achieved R1 billion of consolidation benefits in a 14-month period, and that really put those assets in a position where they can ride out the low PGM basket price that we discussed earlier.
And some of the analysts I've spoken to, they say that in particular Lonmin, you're interested in their smelter as part of your business. What difference could that make?
Look, that is our primary focus, and we've always said that in South Africa we need to be a mine-to-market company. So we don't want to be a contract miner for someone else that smelts and refines. That's a very important part of being in the PGM market, is being able to deal with the end user. It's strategic. There are relationships that are established. So acquiring the processing plant at Lonmin was the primary focus. Now, Lonmin did run a process where we could have just bought that, but we felt that was not first prize, because we would have ended up cherry-picking assets out of Lonmin, and we still would have ended up with major social problems in the Rustenburg region.
How much could this smelter save you on royalties if you could beneficiate more of your stuff before you've exported?
Well, I don't have the exact number on royalties, but the synergies by not toll treating our material at someone else's facilities is about 780 million rand a year of processing synergies.
That's what it could save you.
That's what it could save us. It's very, very significant.
And how, in terms of the company, I mean, what does that equate to? Like the budget for a mine for the year, or what?
Well, not quite. That is probably a 10% reduction in costs.
Okay, significant. So overall, just looking at to the future now, what problems do you see for the already stressed and troubled mining industry here in South Africa?
We have to get to a compact with all stakeholders. Right now, a lot of the relationships are fractious.
There's no other option for Lonmin. I don't think the shareholders are going to put any more money into it, and they are operating at a massive negative cash flow every single day. When they mine at Lonmin, they're losing money, and it's been going on for years and years, and the shareholders have been pouring money into what is now quite clear a hole in the ground.
Now, the next 5 years are likely to make or break Sibanye-Stillwater. The precious metals producer could be remembered in African mining in two different ways. Either as an audacious risk by Neal Froneman that paid off handsomely, or as an audacious gamble that didn't pay off.
That's how heroes are made, right? I think if you want to write yourself in the history book, as one of the great miners in South Africa, these are the sort of deals that you do. But Chris, you're 100% right. It can go horribly wrong. And I think if you look at the share price right now, I think lots of people are not really waiting for a higher gold or platinum price right now.
That is the rough, tough mining business. That's all we have time for on this CNBC Africa special. I'm Chris Bishop. Goodbye.